Let's look at retirement.
Okay.
Can you tell me, what would you say are the standard instruments that should be part of a person's retirement portfolio?
Okay, what's been talked about through the years, it's always go for fixed assets, meaning bonds, bond funds, savings accounts. But what I've been submitting to people also is you can put a certain allocation into the stock market or anything that's equity-laced. Because you have to understand, when you hit 60 years old, if you live until 70 or 80, that's still 20 good years for you that your money should be working hard for you. So what does that mean? If you put all of your retirement fund into something that's fixed or something that will be lower than inflation, the returns that you might get or the spending that you might have 10, 15 years along the line might be lesser. And you might not be able to buy the things that you want if you live until 80 or even more than that.
So how do you suggest to mix those together?
What I normally tell people, it should be based still on, number one, their objective, number two, on how knowledgeable they are in that instrument. Because even though the stock market is really, for me, I believe that the stock market is one of the best ways where they can actually maximize it. If it's something that they can't understand, if it's something that they don't know, better go still to bonds and bond funds and something that will give them fixed interest rates over that period of time. If they would study it, here's how I would allocate it. The more knowledgeable they are into a particular investment, they put more, say 50, say 60% of their portfolio into that, and then the lesser portion of it could be into something that they don't know as much. So what does that mean? If you're knowledgeable in the stock market, doesn't mean you're an expert, but you know what you're getting into. You know the pros, you know the cons of it. For example, I'll just buy a preferred share. A preferred share gives me a greater yield than bonds. At the same rate, for example, I buy corporate bond, for example, PLDT. A corporate bond of PLDT against a preferred share of PLDT, it's just the same company. So if PLDT will close down, all of us are in the same boat.
Correct.
So, and the reason why you're investing in the stock market is, and the reason why you're buying those stocks is you're studying and you know what you're putting into. You're not going to buy a bond, you're not going to buy a preferred share that the fundamentals of that company are shady. So what does that mean?
You shouldn't, at least.
Yeah, you shouldn't. Yeah, you shouldn't. You shouldn't.
Yeah.
So if you would buy it, you can get expected returns that will still be higher than bonds. And that's what a preferred share is. A preferred share is something that will give you bond-like returns, but higher than bond-like returns, but the stability that bonds would give, that you don't get hit by the volatility as much.
Okay.
And that's something that's good for retirement, because you have something that you can compute that you can get as a return.
Good. 2 questions on that. Do you believe in the principle of 100% minus your age is how much you should put in equities and the balance in fixed income?
That's a good principle in a way that it tells you the younger you are, the more aggressive you can be. The older you are, the more conservative you should be. If you don't plan to get a financial planner, you can stick with that. But if you want to become more specific and you want to have the nitty-gritty and you want to allocate it the most efficient way possible, get a financial planner and then just pick it specifically from there.
Makes sense. But the principle is what you were saying.
Yes,
If it's retirement that you're saving up for, the younger you are, the more you can put into the aggressive instruments like the equity market. Is that correct?
Yep. Just to share, my style is this. Since I'm in my early 20s, no, just kidding, I'm in my 30s. My goal is still to accumulate and to grow my stocks I mean the fastest possible way, or the most aggressive type. Why? As I grow older, that's when I start shifting. That's when I start shifting. Because if I become too conservative at an early age, I could miss out on the possible growth there, the possible growth stories. And when you look at the stock market, sure, no one can play a perfect game, a perfect trading plan when they're investing. There can be mistakes. But if you're passive and you know what you're buying, time can still ease it out there. So it's a matter of time, and it's a matter of when you position it.
How soon should you start becoming conservative in the words used? Like 10 years before retirement, 5 years?
It can be gradual. What I do in my personal portfolio, I started to become more conservative when I got married. So before,
because of life stage, and that's another good point.
Because of a shift in life stage. Before, when I was living with my parents, I didn't want to touch. I didn't want to touch preferred shares. I didn't want bonds because. I was saying, sayang. But when I started to see that, hey, wait a minute, I need to shift some into something that will give me unexpected return. It's not a guaranteed return, but it's something that I know I can expect, because that's how it's supposed to be. Then, as it starts earning, some of your funds that starts earning, you try to move some of it already. It doesn't have to be 10 years before. That's when you start shifting everything. It can be something that's gradual. Or a technique that they can employ is this: they're positioned in stocks that have been cheap already. What do? The fresh funds that come in, that's when they start buying the preferred shares. That's when they start buying the bonds. It doesn't have to be they sell everything and transfer it.
Marvin, is it possible to put too much into a retirement portfolio?
Okay, when you say too much, I guess it's in a way that you diversify and for the sake of diversification, you buy too much funds thinking that if I buy this much funds, I'm diversified already.
Okay.
For me, it's about studying which funds are this, studying the objectives. If this equity fund, this bond fund meets my objective, if it gives me the returns that I want, because here's the thing, if I'm 30 years old or 35 years old, I plan to retire at 55, I look at my funds, and then I see that, wait a minute, there's a lot of bonds here. A lot of these are in conservative investments. I'm missing out on the action. I'm missing out on the possible opportunities where I can make money.
Sure. So then you shift it.
Yeah, that's where you shift. It always has to be based on your objective, especially if it's funds, because if you go into funds, the techniques, the strategy on what to buy is already taken out of the equation. The question there that the investor needs to make is this optimal? Is this something where I can maximize the growth to hit my objective in the future?
And to be clear, when you say objective, it means when you want to retire
and
how much you will need for that retirement.
Yes.
So that you can start mixing up your portfolio and achieving that. Is that correct?
Yes. And objective is not just retirement. It can be education or other things that they want to use.
How would you know which ones to keep in your portfolio still or let go of? I mean, you did mention the objective. Are there any other factors?
There's so many schools of thought with that, because if you're investing in the stock market specifically, there may be some stocks that some people, they don't want to hold on to losers for a very long time because they're missing out on the opportunities, because a stock that's bearish or that's a downtrend will continue to go down. Another school of thought is this: they're willing to buy and accumulate that stock even though it's losing, as long as they know it's headed up. So you can stick with your losers as long as you know that it's actually going up, as long as you know it has the potential and you have a plan that you're positioning. You don't stick to a losing position just for the sake of nanghihinayang ka magbenta.
Never do that, right?
There has to be a plan. Either you come in early, you come in late, you cut your losses, or you stay for a specific period of time. It has to be based on your plan. You don't shift your strategy in the middle of the game just because your emotions are telling you, just because you're missing out on the gains in the market. It has to be always based on what you set forth.
Very clear. Thanks, Marvin. This is from Ernie. I still want to get big returns from my investments when I retire, but the risk is high. How can I manage my portfolio in such a way that I can still dabble in high-risk investments?
Okay, what I always tell my clients is this: compute first. How much money do I need for the next 3 years? That 3 years I will set aside into something that will give me conservative returns or fixed returns, because I need the money already. Then I would segment the next 7 years into something that will give me it could be something that's connected to equity, but not as volatile, or it would give me expected returns. This can be your preferred shares, your blue chip stocks, or something that has a very low. I know you discussed beta in the show before. Something that will give you less volatility. Then another portion of your portfolio is you compute. Okay, I still have enough that I can still invest this. That even if there's volatility in this, I won't touch it for more than 10 years. That one you can put into growth stocks, or in our economy, it's a consumer-driven economy. Buy a lot of consumer-driven stocks, because even if you're retired, you're covered in the first 3 years. The next 7 to 10 years, it's already covered in something that has medium-term risk and gain. And the next 10 years can give you the gains that you want that can beat inflation.
Okay. Any parting thoughts that you have on the idea of portfolios for retirement?
There's no secret, there's no one-shot strategy on how to have the best portfolio out there. It has to be a function of what you study, what you know, what you can tolerate, and the funds that you have also. So the best way that you can do it is to actually study, then try it, and then see what's a good mix for you. Because the best way to win in the market or in any type of investment is you knowing what you're doing.